Welcome to Dr. B.R. Ambedkar Open University MBA first year first semester students. In your course Accounting for Management, now we are going to understand about concept of funds flow statement, and in this particular session we are going to understand about various theoretical aspects and fundamental concepts of funds flow statement. Basically, we know that accounting for management subject is to analyze the various aspects of accounting procedures and all. In this process, already you know that financial statements are prepared by every business firm to understand about the financial position of the firm. Financial statements, as you know, they are trading and profit and loss account and balance sheet. They will give a summarized data for the particular accounting period, whereas in the case of trading and profit and loss account, various operational results for one accounting year will be given. That means salaries paid for that particular accounting year, how much will be the sales, what is the total amount of purchases, how much amount of various expenses are met, all these aspects coming under the operational results. Whereas in case of balance sheet, it provides a static view, that means what is the asset liability position on the closing date of the accounting period. Normally, most of the business firms, they will prepare the balance sheet on the closing date, that is 31st March every year. But even though it gives a true and fair view of the state of affairs of the business firm on that particular date only, if any asset is purchased on 30th December or 30th March of the accounting period, then it will be reflecting in the balance sheet. If the same asset is sold on the next immediate subsequent day, then it will not appear. So, that is why it is very easy to window dress the balance sheet, and balance sheet contains the various aspects like stock and profit and loss account position and all, which can be easily changing values. Stock value, if you change the method of valuation of the stock, automatically the value of stock will change, and as a result of that your trading profit will change, hence net profit will change, finally your liabilities also will change. So, even with the smallest change in the method of stock also, your financial statement values always are changing, and total trading and profit and loss account balance sheet, they will provide only a summarized data, but the summarized data is not sufficient for the business for the purpose of taking various decisions. Decision making, as you know, requires always a comparative data. Comparative data in the sense data from the last year, before last year, and so on and so forth. For this comparison of the data in the financial statement, we need to go for the analysis of the financial statements. So, what are the various tools of analyzing the financial statements? Very popularly, we use ratio analysis, and next funds flow analysis, cash flow analysis, trend analysis. Ratio analysis, as you are going to learn, ratio analysis gives the relationship between two financial variables, whereas in the case of funds flow statement, you will compare the data between two accounting periods. That means last year financial statement position is compared with the present position, and last year also can be compared. So, how the financial position is changing on the various years, that is understood by the term funds flow analysis tool. Cash flow analysis basically studies about what are the changes in the cash position of the firm, how the cash is coming in, how the cash is going out, that is understood by the cash flow statement. Funds flow statement, anyhow, that reflects about the fund position and what is fund, how it will be, now you are learning. And trend analysis is the another important method where trends are given for the specific variable, say for example sales, fixed assets, like that every business firm what are the critical variable or crucial variables are identified, and the data for the last 4 years, 5 years is analyzed, and whether the trend percentages are gradually increasing or not, that is identified. If trend is gradually increasing, that means it is an indication that firm's financial position is gradually increasing. If the gross profit ratio, let us consider 25%, 20%, 15%, 10%, like that if it is decreasing, that means firm is not performing well. If it is the reverse of the case, we can say that firm is making good amount of sales and sales is resulting into gross profit. Like that various tools and techniques helps for the analyzing the financial statements, and it will make useful for the purpose of decision making. Now let us understand about funds flow analysis, what is the present topic now. That shows the amount about the movement of funds. Actually, how the funds are acquired, how the funds are applied, how they are used in the accounting period, all these aspects can be understood with the help of the funds flow statement. That is always comparison of sources and application of funds. That means how the funds are coming in, that is the source of fund, how the funds are applied for the various transactions, that is funds outflow, that is considered as application of funds. So funds flow analysis in at large we can say that how it shows about the movement of funds between two accounting periods, and finally it will give a clear picture about inflow and outflow of funds. Next we understand about what is funds flow statement. Now let us understand about what is the concept of fund. We generally use the word fund. We know about reserve fund, we know about workmen's compensation fund and so on. By what is exactly the meaning of fund in financial terms? In the various concepts we use the fund in various meanings. In the narrow sense, what we say, fund means cash only, that is cash flow statement. It analyzes the flow of cash. Then we are using the fund in the meaning of cash, cash flow statement always is helpful. But whereas in the broader sense, fund means it is a pool of financial resources, together sum of financial resources, and how the financial resources are moving between two accounting periods is considered, and not only in the form of cash only. When we talk about the funds in the broader sense, it exhibits about how that funds are coming into the business, how the funds are going out of the business. Whatever the form it means there are various forms in which the word fund can be analyzed, like cash balance, debtors, stock, etc., which are known as current assets. But in popular, fund is also considered as working capital. This is the most useful adaptation of the meaning of fund for this particular lesson now. So what is working capital? That is excess of current assets over current liability. If you know the meaning of current assets and current liability, it is okay. Whereas working capital, that means capital required for the day to day operations of the business. So for the running of business, we need a capital, that is payment of salaries, payment of electricity bill, purchases, and finally for various other purposes we need working capital. So this working capital can be determined as a difference between excess of current assets over current liability, and we have to understand the meaning of current assets versus non-current assets, current assets versus current liabilities for the purpose of carrying out this funds flow analysis. So current assets versus current non-current assets, current assets versus current liability. Current assets are the assets which can be converted to cash within 1 year period of time, and this conversion into the cash means they are liquidated. Current assets include stock, sundry debtors, bills receivable, prepaid expenses, cash in hand, cash at bank, and all these items which appears on the balance sheet asset side. below the fixed assets actually. Assets, as you know, they are basically 4 category: intangible assets like goodwill, fixed assets like land and buildings, plant and machinery, etc., current assets, stock, sundry debtors, bills receivable, etc., fictitious assets, they are profit and loss account, debit balance, and miscellaneous expenditure to the extent not written off. All these aspects come under fictitious assets. Out of all this, current assets play a major role in the determination of the working capital. What are non-current assets? Other than current assets, whatever there, they are treated as a lump sum for the purpose of preparation of the funds flow. Either whatever the changes in the fixed assets, whatever the changes in the intangible assets, whatever the changes in the other assets, that is considered as a lump sum in the preparation of funds flow statement. Current assets, already we understood. Current liability. Current liabilities are the liabilities which are to be paid off by the firm within 1 year period of time. Current liabilities are to be paid off 1 year period of time means that is accounting period. Accounting period concept is very, very important here. Within short term, whether the firm has to pay or not, that is a judgmental criteria to say whether it is a current liability or not. So, normally current liabilities include sundry creditors, bills payable, bank overdraft, and etc., and outstanding expenses, etc. Next, how to use this financial funds flow statement in the financial analysis? Actually, what are the various concepts or various aspects in which funds flow statement can be used? Normally, funds flow statements are basically used to understand about how the funds are coming into the business, how the funds are going out of the business, and this analysis helps the business firm to anticipate or expectation about the future coming money. Yes, within the short term I am going to get this money as a fund, and within the short term I am going to pay for the particular expenditure. Like that, how the funds are coming in, how the funds are going out can be understandable with the help of the funds flow statement. Funds inflow, funds outflow. Inflow means coming in, outflow means going out. When you think about funds inflow, whenever any transaction that results into funds inflow, that is considered as a source of fund. For example, sale of a building, sale of a machinery, obsolete machinery or useful machinery, whatever may be. When you sell a building, when you sell a machinery, automatically money will come into the business. Then funds outflow, purchase of a machinery, advanced machinery, or any other purchase of fixed asset, that is also comes under the outflow. Now, funds flow statement basically concentrates on the working capital. For our academic purpose also, this basis is very, very essential to understand. On the working capital basis, if funds flow statement is prepared, it represents the movement of funds in the working capital. How the working capital is changing over the period of time, whether it is increasing, that is called increase in working capital, or decreasing, decrease in working capital, that is to be understood. Actually, increase in working capital, that means one, it is a considerable factor, then working capital increase is also considered, working capital decrease also may be there. If the working capital is increasing, that is an application, whereas if the working capital is decreasing, that is a source. Actually, this aspect is to be remembered by you. Then coming to the another important element, that is sources and application of funds. What are the sources? What are the applications of that? Already broadly we discussed about this concept. Then what is the rule to say whether there is a source or whether there is a application? As we understood about source of funds, funds coming in, application of funds, funds going out. But when to consider it as a funds flow, that means whenever a transaction occurs between a current asset and a non-current asset, then only funds coming in or funds going out happens. But if it is only a change in the current assets, it will never reflect as a fund. Then, so rule is that the flow of funds occur only when a transaction happens between the current asset and a non-current asset. So, say in the above example you can understand sale of a building. Building is a non-current asset. When you sell, cash is coming in, cash is a current asset. So, like that if you analyze the twofold effect of the transaction, one should be current and another should be non-current. These aspects as a student you must be clear on this, otherwise it will be difficult for you to solve the problems or numerical problems on the funds flow statement. This is only a theoretical aspect, and application aspect let us see in the part 2. Then what is the significance of the funds flow statement here? What is the various purposes or how it helps for the decision making aspect? Helps to understand the adequacy of the working capital. So, if you prepare a funds flow statement, whether the working capital is sufficient or not, and it analyzes the financial position when it is compared to the previous year. Last year what is the working capital, what is the current year working capital, what is the funds flow position last year, and so on and so forth. And on the basis of funds flow statement we can properly allocate the various resources. What is the financial resources, either it is a non-financial resources, how to employ, this is very easy with the help of the funds flow statement. It acts as a future guide for the purpose of understanding the movement of funds. In future what may be the funds inflow, in future what may be the funds outflow, it gives a guidance, and it also gives a guidance for the estimation of the working capital also. How much may be the working capital required in the future years, that is easy with the help of the funds flow statements to determine. Then coming to the most important element, is it fund flow statement is totally limitation free? Absolutely no. Right. Limitations of the funds flow statement. Is it funds flow statement is completely limitation free? Absolutely no. As just like other tools, funds flow statement is also having its own limitations. Actually, in the case of funds flow statement, it is not a substitute for the financial statements. Just by preparing funds flow statement, you cannot ignore to prepare either a trading account or a profit and loss account or a balance sheet. Actually, we take the data for preparing funds flow statement from the financial statement only. That means funds flow statement basically depends on the financial statements only. And here one point is to be understood, any sort of window dressing is done in the funds flow statement, any sort of window dressing is done in the financial statement, it will be transferred to the funds flow statement also. For any change in the financial statement, it will result in the faulty funds flow statement, and it does not show the trend. As already I told you, trend results are very essential for the business decision making. So, when the trend is very important, but funds flow statement also will give a comparison between 1 or 2 or maximum 3 years we can calculate on this, but it does not show on a continuous basis, and continuous changes cannot be understood. Actually, essentially also historical in nature, and it does not provide any future expectations. You can prepare a projected balance sheet, you can prepare a projected financial statement, but you cannot prepare a projected funds flow statement. You cannot prepare a projected funds flow statement. So, it is historical in nature, it depends on the past data, it depends more on the balance sheet and profit and loss account only. Even whatever the change in that leads to the misinterpretation or misresults of the funds flow statement. And next is that changes in the cash position is very important to the business firms. Normally business firms mostly concentrate on management of cash, but not on any other, whether the cash is available or not, whether the cash we can spend or not, like that it will be. So, these are said to be base limitations of the funds flow statement. Next, let us understand about the procedure how to prepare a funds flow statement. Actually, the process of preparing funds flow statement is consists of 4 steps. What are the 4 steps now? First one is that schedule of changes in the working capital. Second one, calculation of funds from operations. Third one, clearing of hidden transactions. Then finally, statement of sources and application of funds. If a student is able to perform all these 4 steps perfectly, he will be successful in the preparation of the funds flow statement. Actually, first one, that is schedule of changes in the working capital. Let us proceed with the one by one, then you will have a clear understanding, then you can apply this theoretical knowledge in the process of preparing the funds flow statement on a numerical basis. Next, how to prepare a schedule of changes in the working capital. As you understood clearly that working capital means current assets minus current liability, excess of current assets over current liability. What happens if the working capital increases? What happens if the working capital decreases? As a student, you can remember that working capital is having two concepts, that is gross working capital, net working capital. Gross working capital is nothing but total of current assets, net working capital is nothing but difference between current assets and current liability. If the current asset increases, as it is increasing the working capital, that is one. Any decrease in current assets, that leads to decrease in the working capital. So, now you can remember in this way, current assets and working capital both will travel in the same direction, they are proportionate to each other, directly proportional. Any increase in the current liability, that will decrease the working capital, any decrease in current liability, that increases the working capital. Then you can understand that current liabilities and working capital are inversely proportional to each other. If current liability increases, working capital decreases. If current liability decreases, working capital increases. These particular 4 rules are very important for the purpose of preparing the working capital statement. So, a statement will be prepared on a pro forma basis. Working capital changes of statement and changes of statement of changes in the working capital. Then last year stock value will be compared this year stock value. It is a current asset, as it is increasing, then it leads to increase in the working capital. Last year current liability, that is outstanding expenses, is 10,000, now current year it is 8,000, that means decrease in current liability, hence it also increases the working capital. Like that, how to adapt the changes in the current assets and current liabilities must be analyzed to determine the working capital. Next one, calculation of funds from operations. Funds from operations means operations are nothing but trading results. First of all, obtain the closing balance of profit and loss account. What is the net profit as per the current year? This is also to be taken from the profit and loss account. Then add non-operating items and non-fund items which are already debited to the profit and loss account, like goodwill written off, depreciation written off, and so on. These are non-operating expenses and non-cash items. Depreciation and goodwill, writing of goodwill, there is no involvement of any cash, hence they are non-cash items, non-operating items also. And then deduct non-fund, non-operating items which are credited to the profit and loss account. These are credited to the profit and loss account means they are considering as income. Then whatever the resultant value, it is known as funds from operations, which is to be shown as a source of fund. So, if you take net profit and add non-operating items, then deduct non-operating income, non-operating expenses and incomes, then whatever the resultant value, that is considered as a funds from operations. If the funds from operations is a positive value, then it is a source of fund. If the funds from operations is a negative value, that is shown as application of fund. Then another important aspect that is to be covered is here is that hidden transactions. Actually, closely observing the 2-year balance sheets, then you can observe what is the changes in the fixed assets other than depreciation value and other than depreciation provision, etc. Any change in the value of the fixed assets or any change in the value of the non-current asset, that is to be identified very closely. So, first of all you have to understand about what is the change in the value of the fixed assets except the value of depreciation. Then what is the change in the depreciation provision, whether any provision is made for the depreciation and any provision for taxation, whether last year how much provision is there, current year how much provision is there, and change in the fictitious assets. What are the changes in the fictitious assets? Like fictitious assets means preliminary expenses which are written off If it is written off, that is to be treated again in the funds from operations. And change in the intangible assets, when change in the intangible assets, goodwill is intangible asset. If any change is there, then that goodwill value change is to be taken care of while preparing funds from operations. And any redemption of debentures, any redemption of preference shares, that should be considered very carefully. And out of all the hidden transactions, how to take care about this one? As a student, you can understand that change in the current assets, current liabilities is taken care of by the statement of changes in the working capital. Then any changes in the fixed assets, any changes in the non-current liability, non-current assets, they are taken care of by the preparation of each individual account, and finally that is to be reflected in the funds from operations. Actually, the hidden transactions are nothing but analyzing the individual assets which are non-current, analyzing individual liabilities which are non-current, and what is the resultant factor out of each individual asset or a liability, especially non-current items only, and whether in the buildings or any furniture or anything else like that assets, whether the cash is going out or cash is coming in, that is to be observed. That resultant factor is to be taken care of by the other statements. So, changes in the non-current and non-current assets and non-current liabilities are to be identified while preparing the accounts. So, first one, statement of changes in the working capital, second one, changes in the funds from operations, third one, analyzing the hidden transactions in the form of non-current assets, non-current liability. Then lastly, sources and application of funds. This is a summarized statement of the above three statements. This is a summarized statement of above three statements, I repeat. Then whatever the result of this one, that is also identified. Whatever the result of statement of changes in the working capital, whatever the resultant value of funds from operations, whatever the resultant value of all the changes in the current assets, current liabilities, etc., that is also identified. And finally, they are reported in a report format. Either report format may be a vertical format or it is a T-shaped format. So, that gives us about comprising of all the sources and applications of the funds. So, this is the procedure for the purpose of preparing the funds flow statement. So, we can understand it even though it is a 4-step aspect here, if you understand clearly all the aspects, you can conveniently do these problems on this also. And working capital changes, funds from operations, all these aspects are to be considered here, right. So, funds flow statement is very essential. Thank you.